Melissa, I'm going to turn it over to you. Melissa goes by Missy in my world. So if I say Missy during the presentation, it's just because I'm so used to calling her Missy. So go ahead.
Thanks, Mary Ellen. Good evening, everyone. Thank you for joining us tonight. We hope you all find the topics useful and informative. I'm sure most of you will probably already have an understanding of what we're going to talk about, but hopefully we'll be able to provide a little bit more detail and maybe you'll learn something new. So I'm going to start off by talking about the operating and capital funds, and then move on to a related topic of Treasury Management, and then finally talk a little bit about the general ledger as it pertains to the monthly financial package. So Mary Ellen, next slide. Thank you. So in the HOA and condominium space, there are primarily two funds that make up the association's equity. It's the operating and the capital reserve fund. So some associations may have additional funds to allocate resources. If they have an ongoing capital project, you might have an additional fund for that. But there are primarily two funds and everything else kind of falls within one or the other. So the operating fund exists for the purpose of providing the associations with the necessary cash to maintain the daily operations of the community and perform necessary maintenance on the property. The budget for the operating fund is determined on an annual basis, and it's primarily driven by property contracts, staffing needs, administrative expenses, and then historical trends as well for things like utilities. And on the capital side, that fund is designated specifically to accumulate reserves for future major repairs and replacements to common area on the property. So determining how much to budget for an association's reserve fund is ultimately driven by the reserve study, which all associations hopefully have. So some examples of that would be, capital expenditures could be roof replacements, renovations to community amenities, facade work, repairs to roads or sidewalks. Next slide. So before I go a little bit more in depth on operating and capital, I do want to just mention the capital contribution fund, which many associations, you might also recognize this as its own segregated account. So capital contributions, just about every association charges a capital contribution fee, which essentially is a fee that homeowners pay when they join the community, when they purchase a home. And whether or not the association charges this fee and the amount of it is going to be determined by your governing documents, and then also it could be dictated by your state laws. But generally, you will see this, and it typically ranges between 2 times the monthly association fee, could be up to 6, or could just be a different arbitrary number. And these funds are sometimes restricted specifically for use on capital improvements to the property. So this means that they could only be used to add an additional asset to the community, as opposed to replacing an existing component. So that's why you might find that some communities, you may have this segregated in your equity. Ultimately, though, the capital contributions really are a part of your capital reserve fund, and many associations will consider it, is available money that they have to use as part of their capital reserve. Next, thank you. So going back to the operating fund. So industry standard is to maintain about 3 to 6 months worth of expenses in an operating reserve fund. Really it's there kind of as a cushion for future unplanned items. Again, your association's bylaws and also state statutes could dictate how the association can treat a surplus. Some common options I've kind of just laid out here, it could just be added to prior year's cumulative operating reserve, kind of is like a nest egg there. The board can also pass a resolution to reallocate a portion of that surplus to the replacement reserve, if that makes sense for them. Or they could also use it to offset future assessment increases. For example, if your association has accumulated a large operating reserve and you are budget planning for the next year, knowing that you are likely going to have to increase fees, maybe, you know, a contract, you know, is expiring and is going to go up significantly. You can apply some of an operating surplus against that increase to allow you to offset, you know, how much you might need to increase homeowner fees in a future year. And then the last option that we just mentioned is that you could also return it to homeowners, but it's really not a recommended option because, you know, there's really always somewhere better that money can be allocated, and it kind of sets a bad precedent, you know, if you're giving that money back to the homeowners that maybe we didn't budget correctly, or, you know, and you might end up needing that money again in a year or two. So on the flip side, if your association is running an operate, sorry, could you go back?
Oh, sorry.
On the flip side, you have the deficit. If the association is running an operating deficit year over year, there's a couple ways to handle that. This could be, you know, incurred by maybe a sudden unplanned expense such as snow removal, and the association might need to replenish their operating account because they just used up a lot of money. So you could you could implement a one-time special assessment to recoup that money. If the association isn't in desperate need of cash, then, you know, you could just plan to fund, to budget to refund your reserves in a future year. So those are some options, you know, on the deficit side, if that's an issue that your association is facing. Next slide. So moving on to the capital reserve fund. So the main driver of the capital reserve fund, as I said, is the association's reserve study. It provides both a physical and a financial analysis of the community's various components and is generally conducted by an engineering firm. It provides an estimate of the useful life and remaining life on all of the various components within the property. And then it also, you know, tells you how much it's going to cost, or gives you an estimate of how much it's going to cost to repair those items. So the rule of thumb with reserve studies is to update them every 3 to 4 years. Really, it's depending on the association's needs, but that's sort of the industry standard there. Next slide. I think you skipped one, Mary Ellen.
Okay. Oh, did I go to the wrong one? Sorry.
That's okay.
I'm getting ahead of myself, girls.
So types of reserve funding, or really ways, you know, to approach reserve funding. And these are types of funding that you're going to see outlined in most reserve studies. So baseline funding really aims to just maintain the capital reserve balance above zero, you know, that you're not in the negatives. This is obviously a pretty high risk strategy, but on the flip side, it allows an association to generally keep homeowner fees low because they're not, you know, increasing to contribute to reserves. Another scenario is threshold funding. So this is where you sort of just set a targeted amount that you want to try to reach to be funding towards your reserves. And then the last scenario is full funding, which is the most conservative approach, and, you know, targets to be able to fully fund the replacement of your common area elements. So most associations, you know, consider full funding a goal and probably aren't going to hit that. You know, they sort of set a target for what they think is realistic and practical for their association, and that's sort of what they strive for. Next slide. So if the association has historically underfunded the reserves by, you know, either not following the reserve study or, you know, choosing to keep fees low, this is obviously going to present some challenges if an emergency expense arises, or if, you have a large capital item coming due that you just didn't plan for. So this could eventually trigger needing to levy a special assessment on the homeowners if you don't have enough in your reserves to cover it. It could also lead to significant fee increases, on the homeowners in the next budget cycle. And then lastly, it can also create an interfund if the association sort of needs to borrow internally from one fund to the other to cover those expenses. Next slide. So this brings me to my next point. What is an interfund exactly? So we see this term come up pretty often this time of year, as many of our associations are going through audits right now. So associations that are on a calendar year end are probably going through an audit or have just completed one. And the interfund tends to come up. So what it is, it basically is created when one of your funds, either capital or operating, borrows from the other in order to meet cash flow needs for the community. So it essentially shows that the total amount in the association's equity for capital reserves, for example, doesn't equal the amount in the bank accounts that are allocated for those reserve accounts. So it is going to appear on your audited financial statements probably as a due to or from reserves. So because of day-to-day operating needs, it's common for the equity accounts to not equal the cash. So it's something to be aware of, and that we wanted to mention because it does come up pretty often. And so there are kind of some options for the boards to decide on if it's something that they determine they want to rectify. So one would be to just transfer funds, basically transfer the cash. Maybe your reserve fund, is being underfunded on the cash side. So you transfer that money from operating to reserves. Another option would be to actually transfer the equity. So a situation where you might do this is if the association has a large operating reserve, maybe in excess of what is really practical for that association. Say, for example, the association has $30,000 a month in operating expenses, and they have a $200,000 operating reserve. They probably don't need that much money in an operating reserve. So the board might decide, okay, this money could be better served in our capital. So we're going to pass a resolution to move that money to capital reserves. So that's an example of what that transfer would look like to rectify an interfund. Next slide. Thank you. So I'm going to switch gears here a little bit now and talk about Treasury Management. So sort of, kind of related to discussion of operating and capital funds, how we're segregating the money. We wanted to discuss this topic. Again, it tends to come up this time of year with audits, specifically in the management letters. If your association, receives an audit, you might get a management letter from the auditor that will have a comment on, how the association is managing their money, if they're exceeding FDIC limits or something like that. And then they might make recommendations as to, how to resolve those type of issues. So we thought that this would be a good topic to just sort of go over in a little bit of detail. Next slide. So there are three primary areas that we just wanted to touch on when it comes to cash management for the associations. So risk management, accessibility, and then liquidity. Next slide. So as board members, you have fiduciary duties. You have a duty to minimize the association's risk to their assets, to their cash in this case. So some items that are important to keep in mind, as I said, FDIC limits, which provides insurance up to $250,000 on all bank accounts held at a single banking institution. So any balance above any money that you're holding above this amount in a single bank is technically exposed to some risk, even though the risk is generally considered to be low. There is a little bit of risk there. And another important consideration is that the primary focus of cash management should be on protecting the principal investment of the association, and getting a return on that really should be a secondary goal. We shouldn't be treating the money as if it was our own personal investments, because it's not. We're investing the association's money, and ultimately we want to make sure that it's protected. And then, so along with that, any sort of risky investment tools such as stocks, et cetera, should really be avoided when investing the association's money. So another important thing to consider when investing association funds is accessibility. While some boards prefer to fully manage their own cash, which is perfectly fine, we generally recommend that the board and management work together to help ensure that funds can always be accessed and are just relatively easy to manage, in regards to opening or closing bank accounts, obtaining bank statements, and just executing transactions, moving money, as needed. So having signers from both the board and management can help here by ensuring that someone always has access. There's obviously will be board turnover, and that can make it difficult. For example, if the association has a long-term CD that comes due and the signers on the account are all board members, but they're no longer on the board, and maybe they no longer even live in the community. And then it gets into a situation where it becomes very difficult for the association to get that money. So minimizing the number of banks where the associations invest can help with the management of the accounts. Lessens the burden on all parties in terms of updating signers when there's turnover, and that sort of thing. For larger associations that maintain a lot of their money in their reserve, keep a high reserve balance, we found that brokerages tend to be a good option for investing, as it allows them to maintain some funds, maintain more funds under one roof, so to speak, and then avoid FDIC limits. So it just makes the management aspect much easier. And then brokerages also give associations access to the entire market for investment options, as opposed to, if you're just investing with a single bank, you only have access to their rates and their specific investment tools. Next slide. So the last point that I just wanted to touch on with cash management is liquidity. So while investing in the association's funds is important, the investments should align with the community's needs. I would say that money market and CD accounts are both very common and safe investment options for communities. If the association chooses to invest in CDs, though, it's important just to have a sense of future spending needs so that funds aren't tied up in CDs, for example, when the association needs them. While you can withdraw a CD early, of course, there are usually penalties associated, which tends to negate, the investment itself. Laddering CDs is a good strategy for communities, again, that have a lot of excess, cash in their reserves, as it allows you to kind of build out your investments to then align with, future projects based on, things that are you're projecting the next 3 to 5 years, for example. Next slide. All right, so the final thing that I wanted to touch on is general ledger review. So this is really specific to our financial package. We find that it tends to be sort of overlooked in the financials. If you don't have an accounting background, you might not, really know what to do with it or exactly how to use it. But we find that it's very useful. So we just wanted to give a little bit of detail on the report. So the general ledger is included in every association's financial package. It's the long report, that makes the package pretty big. In the past, we weren't including it in its entirety. We were only including, income and expense accounts. But we felt that, it's important for boards to be able to see the entire, every transaction that goes on in your community, and really provide that transparency. So it includes all your balance sheet accounts, all the income statement, the bank account detail, your AP, your accounts receivable detail, and your capital, your capital spending as well. So the general ledger really allows you to sort of research within the financials themselves. If you have a question about, a specific number, where it came from, why an expense maybe is so high in a given month. So it really allows you to sort of dig in and get the details on those things. So another thing that I wanted to point out, another thing I wanted to point out in regards to the general ledger is just how the transactions flow for certain accounts. Again, just wanted to provide this for those that may not have an accounting background, just to give a sense of how the information flows within the reports. So for most GL account entries, they're being debited and credited. It's exactly as you see it. But for some accounts, specifically accounts receivable, prepaid assessments, and accounts payable, those balances are pulling from a subsidiary ledger, which is why we provide those supplemental reports in the financial package. So that's, again, it's the AR report that I'm sure you all see, the accounts payable, and I think some associations may get a prepaid assessments report as well. So that's generating all of that activity, and it's flowing directly in. So there's no manual recording of adjustments to the AR GL. It's all flowing through homeowner accounts within the system. So if you have a question as to why your AR balance jumped up $10,000 from one month to the next, you can go directly to the AR report and compare and determine where that difference came from. Next slide. So this is just an example of the report itself, a small section. As I mentioned, provides all the detail on the accounts for the month. So in this snip here, you can see if your electricity expense maybe is very high. You can go to that specific account in the general ledger to look at it and determine, okay, why, maybe why was it so high? Maybe the accountant had under accrued in the previous month, so it's reflecting in the current month. Or maybe we paid a large maintenance invoice out of operating that belonged in capital, which you would be able to see here, and then we could make that adjustment. So it really just provides all of the detail for you as the board to be able to fully understand the financials. And that is all I have. I guess I must have talked fast, but at this point, I think we'd like to open it up if anyone has questions or just any general discussion items.
And you can post in the chat, or you can, unmute and see if you can mention your question. Wow, no question.
I have a question.
Oh, good. Go ahead. Hi, Kristen.
Hi. Actually, I have two, but I'll start one at a time. First, I realized that there's a balance to be had, because on the one hand, you've got FDIC limits and things, and then on the other hand, you don't want to have your money spread out all over the place. So if you're not insured for more than $250,000 at any one institution, you're likely to have, with your reserve funds especially. I'm not quite sure how a brokerage makes that easier, because a lot of brokerage accounts, they're not actually FDIC insured at all, are they?
So it depends probably on the brokerage. So, some that we work, for example, they'll actually insure, they have what they call a sweep account. It's kind of like a holding account for the funds. and then they sort of will invest out, the money to other banks. But it's all held within that, that brokerage entity. But we work with a few that actually will insure their sweep account up to, $2 million, for example. So if you did just need somewhere to sort of park money, so to speak, you would have that extra insurance without needing to disperse it among 10 different, banks.
Okay. And I've already forgotten what my other question was, so I'll
can
I'll
come
think
back.
about it and come back.
We also have a question from Nancy. Nancy, I will reach out to your manager. You should be receiving that in the financial packet that comes to all the board members once they're approved by your manager. It should be in your package. It may not be in your management report, but it comes in the package that is emailed to all board members. So I'll follow up with you. We had another question, interfund receivables, i.e. funds owed to capital. How soon should they be replaced?
So it really just, again, comes back to the association's needs. If you have the money, let's say to your question, if you owe money to your replacement reserve and you have the money in your operating fund, you might as well make that transfer so that you're not carrying forward this interfund balance. If your operating is running a deficit and you really don't have that money to pay back, then that might be an example where you want to consider funding to replenish your operating in a future budget year so that you can pay it back. Because the longer you carry that deficit, it's going to put you in a position that might make it difficult to pay, capital expenses when you actually need to.
Does that answer your question, Edward? And Nancy, the monthly budget that comes in your financial package would be your income and expense. That's usually about maybe the third and fourth page, I believe, of the financials. So I will reach out to you separately and to make sure you're receiving that.
Could you go back to the brokerage account again? I'm not clear about that. Let's say you wanted to buy some CDs. It's really easy to walk into a neighborhood bank and even ladder the amounts and everything, and there's no cost to the community. If you go through the brokerage part, what happens? Is there any money? Do you get money?
Yeah, so I can only speak to the brokerages that we work with and that we have relationships with. So we wouldn't suggest anyone to a community that is going to charge you fees to manage your money. And
I'm talking about your brokerage account, as opposed to not paying anything to walk into a bank and buy CDs. Doesn't cost a penny. So if you go through your brokerage, how does it work?
I think,
yeah.
what do you mean by your brokerage?
You said our.
So I'm not referring to CAMCO as the brokerage. I'm referring to like a bank broker.
Like Janie Montgomery.
Yeah, or like a Charles
Okay, well,
Schwab.
there are charges for that, right?
No, there's not. They don't charge to invest your funds. They get paid in a different way.
How do they get paid?
I can send you the information on it, but the associations that use some of these brokerages, they're not the ones that are paying for their money to be invested.
Yeah.
And it's really just an option. Like I said, it just helps to centralize. To your point, you could go out, and buy a CD at different banks. But then when those CDs come due, you have to physically go in person to those banks and try to, to reclaim the money. If a board member has changed, it becomes very difficult. And, banks that we've got relationships with, they'll generally make it easier. A lot of times we can electronically move money. So it kind of, minimizes some of the legwork, and just, then you know where your money is at, and it moves quicker that way.
Does that answer your question, Patty?
I'm not clear about, I really am not clear about it because we've lost 3 different companies and we had more trouble getting the money out because the companies disappeared on us. So.
Oh, you mean, when you say company, the management?
Yes.
Yeah, see, that's why
If you have
CAMCO,
your own account
Yeah.
and the management is on it and you're on it, then there's no problem. One or the other will be there to get the money. So it's so simple to ladder them, have them tell the bank to roll them over, and you keep, a little bit of looking at it to see whether you want to roll over or not. But it seemed pretty easy to me. I've done it before. And I'm just wondering, I would love to have somebody do it for me, but I don't want a penny to come out, I'm thrifty.
Patty, maybe I can reach out to you separately or have your
Okay.
manager.
Okay,
Yeah, and I'm happy to meet with you also.
okay.
And
I remembered my other question.
go ahead.
Short attention span, I tell you, this time of day, my brain.
No, I hear you.
It's about the accrual thing. Now, I have some financial experience, but not a lot of like the accounting. I'm used to reading reports and things. But this whole idea of accrued expenses, when you gave that example of the ledger and you showed, January accrued expenses, and then in the other column, you had the February accrued expenses, as opposed to real expenses. Could you just provide a very brief explanation of that so that we can understand how to interpret these, if there is such a thing as a brief explanation?
Yeah, right. I guess there's probably no brief explanation in accounting, but so generally, I guess I'll just say, we maintain the accounting for the associations on an accrual basis. So that means that we want to recognize the expenses in the month that they, are incurred, whether or not we receive the bill in that month. So the reason that we're accruing, specifically in that example for utilities, utilities are always billed after the fact. We usually don't get billed till a month or 2 later. But in February, we want to make sure that, we're accruing so that to give you an accurate depiction of what that February expense should actually be, even though you're not going to pay the invoice probably until March. So that's really what it is. It's an estimate. We try to make the estimates as accurate as possible, but it's an estimate of what the expense should be in that month. And then basically what you were seeing on the ledger is the reversal of that entry in the next month when we actually record the expense.
Okay, thank you.
Sure.
We just had one other, which I answered up from Russ, operating reserve to capital reserve is okay, but he doesn't think you can transfer capital to operating, and you are correct on that.
Unless it were a loan. It wouldn't be an outright transfer, but you could loan money or no interfund.
So from a cash standpoint, right, you might have instances where, you're using cash from the operating, but yes, on the equity side, you can't make that transfer.
Okay.
Any additional questions? We have some time. This was a quick one. I just want to remind everybody that we're on April 12th. We're having a new member board orientation. We will send that out just like you receive these board member roundtables. And then on May 3rd, we have a doozy, loans and special assessments. It's going to be really good. I think there's a lot of associations that are dealing with that. We are looking to have NCB speak about loans, and then we will have somebody, it may be Melissa from our financial team, to speak about special assessments.
Sorry, can you repeat the date? May?
April 12th and May 3rd is the one on loans.
Okay, thank you.
And you can always reach out to your manager if you have any questions and you want to talk to your accountant about any of the things that we talked about on here. Please, reach out. Your manager knows who your accountant is, and they will either they can schedule a meeting or a Zoom. I know I do that a lot with some of my board members, and sometimes you have that one-on-one with your accountant, and it really helps to clarify things with your association. So don't hesitate to reach out. And thank you everybody for coming tonight. And thank you, Melissa, for presenting.
Thanks, everyone. Yeah, and don't hesitate. Mary Ellen, I guess if you want to share my contact, don't hesitate to reach out to myself either, if I can assist with that.
Thank you.
Thank you.
Thank you.
Thanks,
Thank you.
everyone. Take care.
Thank you.
Thank you.
Did you want me to stay on or
Well, I'm Patty, what association are you with?
I'm with Comcast?
With what's the name of your association?
CAMCO?
Okay.
Oh, our association is Meadowview Estates.
Meadowview Estate.
Oh, okay.
That's what I was looking for. Okay. We will have somebody reach out to you so that you can get a better understanding, unless you want to hold on and Missy and I will stay on.
Could I attempt to answer Patty's question?
Sure.
Do you
All right.
mind, if it gets too much time, we can postpone some of it, but just,
Patty, I understand where you're coming from and what I did like 4 years ago as a board member. I said, we're getting a zero return on $100,000 that's sitting around. Why are we doing that? So we contacted, I'm not endorsing anybody specifically, but I contacted Edward Jones and got in touch with a financial advisor there. There's no fee for what they do for us. I said, I would like to open up 3 accounts, one with $15,000 that's due in 6 months, one with $15,000 that's due in a year, and one with $15,000 that's due in 18 months. And that way, if I run into a shortfall in a short period of time, I've got 6 months, I've got 15,000 that I could immediately get my hands on without fear of penalty for early withdrawal. They charge nothing for the fees that they extract, they get from the places in which they invest our money on our behalf. So it doesn't cost us anything to park our money there. And I still had plenty of money left over for reserve money. But I thought we need to get some return on this, and that's what we've managed to accomplish. That was the way we managed to accomplish that. So I don't know if that clarifies your thinking or not.
a little bit, and the brokerage people are the ones that make the decision about where to put that money, or?
Well, no, not
You
without
tell them.
going. Oh, no, they call. I get a report every 30 days that I share with CAMCO. And on that report, our financial advisor that represents our association keeps us posted as to every time something's rolling over, this is what's out there. What do you think? And then you get to make that decision. She, in this case, she does not make that decision for us. We make that decision as a board.
And your financial advisor, is that coming from the board people or from CAMCO?
No, that's coming from Edward Jones.
Okay, sounds good.
Okay,
Been doing this for a while?
yes, 6 years. And I ran my own business for 40 years prior to that, so.
Patty,
Yeah,
I'll have your accountant reach out to you along with your manager about some of your
There you
questions
go.
as well.
Okay.
Thank you, David.
Yeah,
Sure,
thanks,
yeah.
David. That's really
Actually,
helpful.
I think we're having a meeting this Thursday. But if somebody wants to reach out to me to explain it more, I'd be happy.
Okay,
Yeah, I'm happy to follow up with you.
Okay,
thank you.
thank
Thanks to
you.
everybody. Thank
Thanks,
you.
everybody.
Melissa,
Thanks.
thanks.
Thank you.